In 2011, three researchers at Harvard and Duke ran an experiment that would change how we understand the psychology of ownership. Michael Norton, Daniel Mochon, and Dan Ariely gave participants unassembled IKEA storage boxes. One group assembled the boxes themselves. Another group received identical boxes that were already assembled. Then both groups were asked how much they'd pay to keep their box. The results were remarkable. People who assembled their own boxes valued them 63% higher than those who received pre-built ones. The boxes were identical. The only difference was labor. This phenomenon, which the researchers named the IKEA Effect, states that people disproportionately value things they helped create, even when the result is objectively mediocre. And this bias doesn't just apply to furniture. It applies to your money. The IKEA effect is operating in your financial life right now, and unless you understand it, it's probably costing you returns. Let me explain how. Application number 1. Stock picking versus index funds. Every piece of evidence in financial research points to the same conclusion. The vast majority of active stock pickers, including professional fund managers, underperform simple index funds over long time periods. The SPIVA scorecard, published annually by S&P Dow Jones, consistently shows that over any 15-year period, approximately 90% of actively managed funds fail to beat their benchmark index. Yet millions of individual investors continue picking stocks. Why? The IKEA effect. When you research a company, analyze its financials, and decide to buy its stock, you've invested labor into that decision. That labor creates emotional attachment. The stock isn't just an investment anymore, it's your creation, your pick, your thesis. And because of the IKEA effect, you overvalue it. Brad Barber and Terence Odean at UC Davis have spent decades studying individual investor behavior. Their landmark research analyzed over 66,000 household brokerage accounts and found that the most active traders, the ones who put the most labor into their investment decisions, earned annual returns of 11.4% gross, but only 6.5% net after trading costs. Meanwhile, the market returned 17.9% during the same period. The investors who worked the hardest performed the worst. Not because they were stupid, but because the IKEA effect made them overvalue their own analysis, trade too frequently, and hold losing positions too long. This connects directly to another well-documented phenomenon called the disposition effect. Dean's research showed that investors are 50% more likely to sell a winning stock than a losing one. Why? Because selling a losing stock means admitting that your analysis, your creation, was wrong. The IKEA effect won't let you do that easily, so you hold the losers, sell the winners, and systematically destroy returns. Application number 2. Budgeting. Remember the 50-30-20 rule from our earlier video? One reason people cling to complex budgeting systems even when simpler approaches work better is the IKEA effect. If you've spent 20 hours building an elaborate spreadsheet with color-coded categories and custom formulas, you'll value that spreadsheet far more than its actual utility warrants. You'll resist switching to a simpler system, even if the simpler system produces better results, because abandoning your spreadsheet means abandoning your labor. Norton's follow-up research found that the IKEA effect is strongest when the creation is successfully completed. If participants failed to finish assembling their box, the effect disappeared. This has a direct financial implication. People who complete a complex financial plan feel enormous ownership over it, making them resistant to updating it even when circumstances change. The plan becomes sacred because of the effort invested, not because of its effectiveness. Application number 3. Entrepreneurship and business investment. James Montier, author of The Little Book of Behavioral Investing, has documented how the IKEA effect creates what he calls the ownership premium in business decisions. Entrepreneurs consistently overvalue their own companies compared to objective market valuations. A 2014 study in the Journal of Finance found that founders valued their startups at roughly 3 times what outside investors would pay. This isn't just optimism, it's the IKEA effect. They built it, so they believe it's worth more. This has real consequences. Founders hold on to failing businesses too long. They reject acquisition offers that are objectively generous. They pour more capital into ventures that the market has already priced. The labor they invested distorts their perception of value. So the IKEA effect is clearly dangerous for your finances. But here's the twist. It's not entirely bad. In fact, when channeled correctly, it can be one of the most powerful wealth-building forces available to you. Positive application number 1. Financial education. The IKEA effect means that financial knowledge you acquire through active effort is valued more and retained longer than passive information. A 2018 study by Fernandez, Lynch, and Nettemeyer found that people who actively worked through financial scenarios retained 74% more knowledge after 6 months than those who passively read the same material. When you build your own understanding of compound interest by running calculations yourself, that knowledge sticks. When you read someone else's explanation, it fades. This is why the most financially literate people aren't those who read the most, they're those who practice the most. Positive application number 2. Automated systems you design yourself. Vanguard's research on what they call Advisors Alpha estimates that a good financial advisor adds roughly 3% per year to client returns. But here's the interesting part. Most of that value comes from behavioral coaching, meaning stopping clients from making emotional decisions, not from superior investment selection. If you can build your own automated investment system, one that removes emotion from the equation, you capture most of the advisor's alpha for free. And because you built the system yourself, the IKEA effect ensures you'll stick with it through market volatility when others panic and sell. Positive application number 3. Goal-based saving. Research by Soman and Zhao at the University of Toronto found that people who actively constructed their own savings goals saved 38% more than those who were given identical goals by an advisor. The goals were the same. The savings rate was dramatically different. The IKEA effect turned personal involvement into motivation. So here's the framework for using the IKEA effect wisely with money. Build your own financial system, but fill it with evidence-based tools. Design your own automation, but use index funds instead of individual stocks. Create your own savings goals, but let the system execute without your emotional interference. Invest your labor in the architecture, not in the individual decisions. The people who build the most wealth aren't the ones who pick the best stocks. They're the ones who build the best systems and then get out of their own way. If this changed how you think about DIY finance, hit subscribe and turn on notifications. Every Tuesday and Friday, we break down the real science behind your financial brain. Next up, we're revealing how credit cards physically rewire your brain, with evidence from actual fMRI studies that show your neural pain circuits shutting down the moment you tap instead of pay with cash. Link is on screen now.